Good afternoon. This is Alan Sykes with Sykes and Company PA in North Carolina. We have with me Scott Sykes, also shareholder in our firm. Also today we have Dave Malinsky, who is with Datarithm Inventory um, cloud-based systems software company that will be uh, discussing a number of features and benefits to what the Datarithm system does with respect to aiding and embedding independent pharmacies in their growth prospects. We appreciate you being with us today. Some of you may have been with us on our last webinar where we were with Inventory IQ talking about some similar issues that we'll be talking about today. But we're going to be diving into a little bit different approach today, again, with Dave being our guest today. And Dave, we're glad to have you on the call today. Dave, you can hear me fine. Is that correct? Hello, Dave.
You lose Dave? Can't hear Dave.
Yep. Pardon us just a second.
We just had him.
Can you hear me now?
There we go.
We can hear you now. Okay.
There's Dave. All right.
All righty. So, Dave, just want to make sure you're with us. And again, we went through the introduction, and you can hear us fine. Is that correct?
Yes, I'm good. Thank you.
All righty. And Scotty, you want to go ahead and start the first slide, please?
Yeah. So we appreciate everybody being on today. We've got Dave with Datarithm. I do want to say, throw your chat questions in the chat box as we're firing away here. We'll answer those as we go along. So feel free to ask any questions you got. Now, if you were on our last webinar, we discussed inventory with Inventory IQ. We actually have the same slides today, but we got a different perspective with Dave and what he does from his side with Datarithm. So we're going to kind of carry on the same thing here. But again, we just had a conversation before we got on and discussing the change in the industry and what the PBMs are catching on with, et cetera. But it's all heading towards, and it's all heading towards inventory and making sure that inventory is under control, that you're maximizing the efficiency with your inventory, because in years past, margins weren't as tight, PBMs weren't what they are today, DRR fees weren't there. We're now in a period in a time in pharmacy where there's not any excess in pharmacy, and you have to really run as tight and lean as you can. And in the past, inventory's always had a little excess. I think a lot of pharmacies had excess in inventory. Now, you can't really have that because that's dollars, right? That's dollars on your shelf that need to be in your bank account. And thankfully, in today's environment, there's vendors out there, Inventory IQ, Datarithm, that are able to help you maximize inventory and take inventory seriously, because that's where a lot of excess cash is sitting that pharmacies need to start getting a better handle on. Not only from a cash perspective there with inventory, but inventory is vital for your financial statements and for your pharmacy as a whole. So when you're going in and you're looking at financial statements on a monthly basis, month in and month out, and you're not getting accurate inventory, your margin's going to be incorrect, your cost of goods is going to be incorrect, your bottom line will not be correct. So that inventory is a vital component of your balance sheet. And if you're just guessing at what is on your shelf and what the inventory is at the end of each month or at the end of the year, you're really doing yourself a disservice, because guessing's not a business strategy, and it's definitely not a strategy in pharmacy given the nature of the industry. So inventory is key, and we got to get a handle on it. So Dave, I just want to get your perspective on what you're seeing as far as inventory and how inventory is changing and how pharmacies are changing and adapting to better manage their inventory today.
And also, Dave, just adding to that, your Dataritm's approach to maximizing cash flow and inventory maximization in independent pharmacies, because that's who we have on the call today, are independent pharmacies who are trying to maximize every dollar they got on the shelf. Just give us some idea of the theory behind what Datarithm is doing, please.
Sure. Well, firstly, just an observation that over the years we have seen more and more independent community-based pharmacies actually moving towards and getting to use perpetual inventory, which is key. So we're seeing that, which is a good thing. That's definitely a positive move. Unfortunately, what we continue to see, though, is some of the same old story that we saw from the very beginning, which is pharmacies are overstocked. They have surplus and dead stock. They're also understocked in some places. So both of those can cause problems. So there's one observation. But I do see that people are seeing the light, and again, moving towards perpetual, which is a great start.
And so tell us about how Datarithm can help them. What you guys do for someone who is on perpetual system, what you guys can do to help them enhance the perpetual for what they're already doing.
Right. So once you're on perpetual, what we can offer is an automated approach. Okay, so if you're on perpetual today and you're not automated, you're managing those order points. And as everyone knows, you have thousands of those to manage in every store. Okay, that's an impossible job for any one person or even a team. Okay, imagine thousands. And to do it properly, you need to stay on top of that for any kind of change over the course of a month or any period of time in your usage volume. So you need to adjust your order points based on the situations at hand. So again, it's very much an impossible job to do that manually on the fly. So I believe that it's the automation that we bring that is really a core to the benefit. And leveraging usage history and then sophisticated math and algorithms to do our work, to set order points and to predict usage or to create demand forecasting for every item or generic group in the store.
And for someone that's out there that's not currently on a perpetual inventory system, Dave, what would you say are the disadvantages they currently have in this environment, in today's environment?
Yeah, several. Firstly, time-intensive ordering. Your end of the day is taking you more time, certainly, than it would if you were using perpetual. Secondly, you have an elevated percentage or odds for theft, fraud, and diversion because you don't know how much you have. And financial conditions are largely unknown. So how do you make proper and informed decisions about ordering and just general inventory management? A couple other points: high exposure to stockouts, overstocks, and expired returns, which are all dangerous situations where you can't service your customers, you're carrying too much, you have too much carry cost, things are sitting on the shelf, and all these things are then exposed to a real problem: expired returns, where you bought something, it went dead, you now have too much, you carry it into the end, and when you return it, you're going to get something between nothing and something. Okay, so caustic. And lastly, when you're not doing perpetual inventory and you just do that count once a year for your accounting firm, your inventory is only accurate right then and there. And as time chips away, it'll fall backwards into less and less accuracy. So those are some of the problems that we see if you're not running perpetual.
Yeah.
And
Go ahead.
what percentage of those do you think are on perpetual out there today, if you had to guess?
I would say that going back several years for all independents, I would say it was certainly less than half. I would say it's better than that now, and maybe 50 to 60% possibly. I might be wrong on that, but that's just an observation. We have seen more and more lately where we are being asked to bring people to perpetual. Okay, so as everyone knows, you need to have good on hands and you need to have order points for every item in the store. So as long as you can do a count, we can bring the order points.
And as far as your order points are concerned, on your inventory reordering process, how does your system refine that process as you go along?
Well, firstly, let me explain what the process entails. Firstly, it starts with the forecast, which leans on the usage histories for every item in the store. So we take that and we create a forecast for usage using algorithms. We take that forecasted usage and we then apply it to settings that are controlled by management, and that helps us guide the way to the order point position they want. So they are in control. We are not a black box. And so every month when we see changes in usage, order points are adjusted automatically through these interfaces that we have with various of the leading pharmacy management systems.
Dave, what are you seeing as far as how does your system, how are you guys enhancing synchronization inside a pharmacy? What does your system do to enhance synchronization, or what a pharmacy may be doing as far as syncing?
Well, I believe that at the core, it's really about using the right reorder points. And if we're constantly adjusting based on usage levels, we provide that benefit. We do have in our system for very expensive items a functionality where they can actually order in real time. So if you've got a patient involved in sync that's involved in some pretty expensive meds, you can actually guarantee yourself good service levels, but you don't have to carry these things between fills.
Yeah, so we're definitely seeing synchronization as a key player as far as inventory management and control. I've seen some pharmacies that are syncing where it's synced so well that when that delivery comes in, it's not even going on the shelf. They're filling it and filling the prescription. It's going out the door. So we're definitely seeing synchronization. Those that are taking that seriously and putting all their efforts into that, they're definitely seeing that pay benefits because their inventory turns are 18, 20 plus inventory turns. And you think about it, when you're turning inventory that much, that's more cash flow. That's more inventory that's not sitting there taking up your dollars. It's going right out right in the bank account. And when you're thinking about the cash flow inside a pharmacy, you've got 10 days to pay your wholesaler, but you're not getting paid for 30 days. So the more you can turn that inventory, obviously, the better there. So we're definitely seeing synchronization play a key role there.
And Dave, do you have any recommendations with your system with respect to cycle counts, and perhaps describe to the listeners what we're talking about when we're talking about cycle counts with perpetual systems?
Yes. So cycle counting, I would describe it as taking a bite-sized piece as often during the course of a week that management would like, and count 20, 25 items. Okay. Again, your accounting firm is going to mandate that you do a full count for tax purposes and whatnot. But if you can continue that throughout the year and do cycle counting, what you're going to do is you're going to have a higher level of precision throughout the calendar. Okay, which means you're not going to be overstocked and not know it, understocked and not know it. So the greater the level of precision you can maintain across the calendar through a cycle count, the better you will be. You can avoid stockouts and you can avoid overstocking as long as you know to a greater precision level what you really have on hand.
And of course, when you're using cycle counting, which is in essence keeping the perpetual system in a much more precise process on an ongoing basis, as you get to month in and run your inventory reports, and I'm sure that your system has some type of special month end reporting process, and I'll let you talk about that in a minute. But one of the points that we would like to make as CPAs that work only with pharmacies all over the country is that if you're not taking that adjusted inventory, again, hopefully perpetual, hopefully cycle counting, hopefully an accurate process that you have, and making accounting adjustments, then your cost of goods sold and your gross profit and your net income pre-tax is not going to be accurate on those QuickBooks files that you're running. If all you're doing is entering the deposits, letting the system write checks, and not making adjustments for the inventory as we're talking about here, and in addition making adjustments at month end for receivables, payables, etc., the key balance sheet categories are so critical to making sure that you've got accurate financial reporting, that if you're not doing this, you don't have a clue where you stand other than what money perhaps you have in the bank. And using QuickBooks as a check writer and depository uh, uh, piece of software is not what the system is designed to do.
That's right. Dave, what technologies, what technology, how is the technology improving from where it is today? Whether it's AI, artificial intelligence, or more complex algorithms, whatever it may be. What technologies are you guys seeing or doing to continue to enhance inventory overall for pharmacies?
Sure. Well, firstly, our system is a cloud-based system, so we can adapt quickly. As long as you've got access to a password and the internet, you've got access to your inventory. So you don't need to actually be in the store to manage it. I guess my main comment would be that over the years we have listened to our clients, and they have become the basis of many of the changes and the improvements that we make, and we continue to do that on a monthly basis. So in terms of technology, we're cloud-based, but we adapt and react to the needs that are expressed by our customers.
And Dave, your software, does it run? Do you have an app like for mobile, iPad, or is it just run on a desktop version? Or
Well, it is cloud-based, so you can get it on your phone, etc. We will soon be moving to a different version that'll be a better display on those devices. But because it's cloud-based, as long as you can get on the internet, you can get to your page on our system.
Gotcha.
So as far as inventories, the typical pharmacy we're seeing, and historically NCPA averages and everything, historically the inventory turns are around 11 times a year. Of course, that's your cost of goods sold divided by your average inventory. And, you think about that 11 times a year, that's about as bad as it gets, folks, because when you have next day ordering, when you have the technologies such as Datarithm, when you have perpetual inventory systems, and syncing, you should be able to get inventory up to 15 plus times a year, turns a year, and that is cash flow to your bank account, folks. And unfortunately, this is what we're seeing in the industry. So I hope we can continue to see this improve over the next several years. But we are starting here at the rock bottom, which I think is 11 turns a year. And Dave, what is this about? What you guys see? Any typical pharmacy that you run into out there?
That's about right. Our
Yep.
clients come at us typically around that number. Some are lower, some are a little higher. What we've been able to do is, on average, improve turns by 4+ points, which turns out to be about a 36% increase over time. That does require that there's some compliance with the things that we're asking them to do in our system, but generally 11's about right. And I would agree that's about as low as you'd ever want to be.
Yeah, I'm aware of one client we have with you, David, on your system that has returns of 27 times a year, and many others that have better than 20 turns a year. And it's like Scotty said, with med syncing, with next day ordering, with technology as it is today, with products like what we're discussing here. I've been in the industry a long number of decades, but it's just beyond me why inventory turns basically one time a month. I don't get it. I never have understood that. And that's the reason for this call, because when we see inventory for a typical pharmacy anywhere from $200,000 to $700,000, obviously depending on the size of each store, and you can start, and you're turning that multiple times a year, more so than you are now. The money that you're turning in, the money that you're turning over into the bank, the money that's not being kept on the shelf but in the bank itself, in the typical cash cycle of taking cash, buying inventory, selling inventory, generating a receivable, collecting that receivable again, and turning it back into that cash cycle is tremendous. And that's the point we're trying to make here. And we talked earlier about the percentage of pharmacies that Dave has seen out there with perpetual systems. It's our experience that in the 40 to 50% range of pharmacies in the field are having perpetual systems. Dave is seeing a little bit higher than that. Whatever that number is, 40 to 60%, where are the other 40 or 50% of the folks? Why are they not trying to maximize what they're doing? Again, utilizing technology in this process and hopefully increasing cash flow. And where in this era, in fact, we just talked about this before the webinar started, in the era of diminishing reimbursements, especially with those that have been doing data analytics, and certainly that's not what it is today, what it was 2 or 3 years ago. With that being diminished, this whole concept of turning that inventory, turning that cash, creating that profitability, and increasing that gross margin to whatever number of basis points you can becomes critical in retaining and building that bottom line. It's just, I don't know, it's just beyond me.
Yeah, and if you are part of that 50-60% that does not have perpetual inventory, you've got a whole world of opportunity to take that seriously, to focus on that inventory, because and Dave, you can correct me if I'm wrong, but I pretty much guarantee that those pharmacies, those 50-60% of pharmacies, are leaving cash out there somewhere that's impacting their overall cash flow, and whatever other plans they have inside the pharmacy. So huge opportunity for the industry here to get on board with the inventory, get a perpetual system in place. Not only are we looking at enhanced cash flow from managing that inventory from a better perspective, and understanding that inventory, because when you've got this technology that's analyzing what you're doing and what you're feeling and the demand shifts and everything, you have control over that more than you ever have before. And what you think you know, you don't know. So but when you have that, and then you tie it into the financial statements, and you're able to see exactly and get those inventories each and every month, you are able to see exactly how that's impacting your margin and your bottom line. The dividends are huge, because then from that point you can better plan, you can better manage, you do tax planning, you just take it to a whole nother level. And it's just crazy to me, but these are opportunities out there for pharmacies that we definitely want to bring to everybody's attention.
And I want to again mention to you that if you have questions, feel free to put them in the chat box there, and they'll pop up on the screen, and we'll answer them. And actually, we got a couple of questions that have come through here, Dave, and this one really relates directly to you. Aaron wants to know the benefits and downfalls related to multi-store inventories. When you have a group of stores, let's say in an entity, let's say you got 4 or 5 stores, and let's just say you're running something like a Pioneer system in that process. What type of benefits and downfalls do you see with the utilization of your product in that process?
Okay. Well, firstly, I really don't see any downfalls whatsoever, only the upside. And so what would that be? Well, typically what we've been able to do, and this is an average, about a 20% reduction in your investment level in inventory. And again, that's an average that we've seen at the high end. We've seen people reduce their inventory levels north of 45%. It's astounding. And at the same time, we're actually improving their service level, the ability to fill scripts as presented. You might be wondering, well, how can we do that? Well, it's optimizing your order points and resetting them every month based on changes in demand. And it's by using what we call balancing. So where we make recommendations to return fulls when we think you have too much of it. And then using a transfer mechanism to move surplus out of a store that's got too much or it's gone dead and place it into one of your sister stores that is using that drug. Corporately, you win. Okay. You're also fending off future risk of expiration, right? Again, there's nothing worse than dead stock, because that is tomorrow's expired returns. So you can attack that dead stock, that surplus, with balancing if you are a multi-store chain. And even if you're a singleton, you're still going to get that return benefit as well.
And another question we have out here, Dave. Let's say someone has a perpetual inventory system, they have a sync program, and let's just say they're using one of the more popular script management systems that are in the market that calculate recommended reorder points based on the history in that system. How does your product differ from what some of the more popular script management based systems are doing there internally?
Well, I can't say for certain. We don't know the inner workings of those that do what we do. I can only tell you what we've done. I can say that, just generally speaking, there are a few out there where we have gotten their business, and we've done pretty close to what we do with everyone, about a 20% reduction in inventory, et cetera, et cetera. So again, we don't know specifically what they're doing, but in many cases, we seem to do a better job.
Yeah. And as far as your internal ordering system is concerned, with some of the more popular systems, comments on that?
Yeah, one, we do not do the ordering. Okay, we do not step between your pharmacy management system and your various wholesalers. We prescribe that the PMS has that capability. You probably have been using it, and we don't want to disturb that and add more work or change.
Okay, that certainly makes sense.
Any other questions? Is that it?
That's it right this second.
All right, Dave. Track and trace. You're hearing a little bit about this out in the market today. What have you guys heard? How are you guys preparing for, if at all, for track and trace, and what this may mean for pharmacies? Because I know it's still rather unknown at this point, but there is talk of this coming up down the road. Is there anything that you guys are implementing or doing or planning to change to help pharmacies ultimately comply with this new regulation?
Yeah, we keep attuned to it, and there are some things that we actually do today that are, probably sufficient at this point. Which is, if you are doing a transfer between stores, or we actually maintain an archive of all this record, so it's going to show you the drugs and the NDCs and the quantities, the amounts, etc., that move from one store to another, and that's an archive that's there always. What our plan for that archive is to increment it by requiring in the future that when a store moves an item from one to another, that we start capturing the expiration, the lot number, etc. Some of the things that will be required. Now, in terms of the required paperwork, I mean, that typically has been offered by the wholesaler. So your track and trace legal documents should be out there and available to you through your wholesalers. We're going to have an augment to our archiving system.
So would you say, for multiple stores, where obviously coming from the wholesaler, it's being tracked pretty well, when it gets into that one store perhaps, and is maybe distributed out to other stores, that your system is adding a great deal of credibility, if you will, to the process with the intercompany transfers and the documentation your system's keeping?
Yes, I do. I mean, the law says that as long as the ownership is within the same group, that you're free to transfer between stores. So our archive keeps track of that. We're going to just make it stronger by adding these additional data points, if you will.
Okay. We got another question that's popped up here, Dave. This one's for you as well. I'll just read the question. It says, how would Dave's systems help with increased inventory due to 340B contracts when using perpetual inventory and third-party companies like Microhelix?
Great question. It's just a general answer that, if this happens to be a situation with multi-stores, the transfer function will help them, tone down what they're getting. 340B has a tendency to run people over, especially in the beginning. If we're optimizing order points and surfacing surplus inventory, our return functionality, our transfer functionality can only assist in trying to keep some sanity to the impact that can occur.
What do you mean by run people over with the 340B?
Well, what we've seen is that in many cases, because the store is ordering, as they always had been, based on an order point, perhaps, right? So they order, a atorvastatin 80 here today, and next thing you know, that comes in from their wholesaler, and they also get a drop ship from their third-party 340B entity, and they didn't see it coming. So now they've got twice as much as they had ordered, twice as much as they ordered. They got what they ordered. They got additional. And it's because that the accumulation that happens up at the 340B company, then without notice, bang, it arrives at the store. So they can find themselves with elevated inventories because of that.
And let me add a 340B question. With 340B contracts where the replenishment process is set maybe for a monthly reordering arrangement, whether it's a whole bottle or partial bottles, how does your system assist other systems that are out there, or is your system serve as a replacement for that?
I'm not so sure I'm understanding the question. Could you give me a little more detail, Olin?
Well, let's just say you've got a replenishment situation that at the end of each month, when full bottles are empty, that you're creating a replenishment receivable, if you will.
Mm-hmm.
And I've seen some cases when there are partial bottles, especially of expensive specialty drugs that are on the marketplace, allows for that replenishment receivable to be created. Is there anything particular about your systems that help in improving that cash flow from that replenishment receivable process?
Without getting into too much detail, again, I would just go back to the generality that if the reorder points that we are calculating are based correctly on overall usage, they should be set appropriately. And so, because there's no view into what your third party is going to do and when they're going to send it, I'm not so sure that there's a way around it, if you will, right?
Yeah, I'm with you.
So that's a sticky wicket.
Yeah.
Yeah.
I'm with you on that.
That just adds to the complexity of 340B overall. Good question.
Which by the way is an accounting nightmare if you're not handling that correctly.
Sure
From
is.
a perspective of of your store. I will tell you that 340B is an area all by itself. It's an animal that if it's not properly accounted for, then your numbers on your financials are just absolutely incorrectly stated, skewed without question.
And actually, I will go ahead and plug. I think we're going to have a 340B Master the Margin webinar.
Yes, we are. Yes, we are.
So
and we actually planning on that this week, as a matter of fact.
We'll be plugging that. Yep. All right. So physical inventories. Let me clear this. Physical inventory. So, we always suggest pharmacy probably get this once a year, maybe twice a year if we need a couple extra data points there, given the unique situation of the pharmacy. But typically once a year to shore up the perpetual system, to confirm everything we are seeing through the perpetual system and what the margins through the year. Of course, if you are going to be doing physical count, which we suggest, of course, you want to do that in the third or early fourth quarter. You don't want to do that at the end of the year. End of the year counts are going to might throw you some surprises at the end of the year. Surprises as in more income up or less income, just depending on how that adjustment flows through to the bottom line. So early fourth quarter, third quarter, get those inventory counts in so you can do proper tax planning and know what to expect through the rest of the year. Now, Dave, how do you recommend physical inventory counts and shoring that into the Datarithm or the perpetual system? How do you guys incorporate that into what you do?
Well, two parts. Firstly, what is the best way to do a full physical count? Firstly, zero out your on-hand positions, and then count every physical piece on the shelf. If you don't zero it out, you'll have ghost inventory, whether it's positives or negatives, and that can influence what you folks as CPAs are trying to fend against. We talked earlier about the cycle counting. Just a little more detail there. In our system, when someone wants to deploy cycle counting, we use a dual ranking approach. So we rank every single item in the store by cost and by frequency of use. We marry those ranks together, and so what we allow them to do in our counting mechanism is to place the proper emphasis on those items that are more expensive and that are more frequently dispensed. Those are the items that you want to count more often over the course of any calendar period. And then lastly, we allow them to select the days of the week that they want counts to occur on. And through those two types of mechanisms, they're in control of the length of the count. But again, the key is put emphasis on the things that should be counted more often: expensive, faster movers.
Couple of thoughts on physical inventory counts too that those on the call may be of interest in hearing. What the last thing we want to see is somebody saying, well, I'm going to do my inventory on December 31st at the close of business. They do it, you get it at the end of January, and then your inventory is up or down $200,000 different from what was on the books, and all of a sudden, whatever planning that you may have had in place gets totally thrown out of kilter, and that doesn't help. That's the reason we're talking about if you're going to do physical counts, if you're going to do cycle counts, whatever you're going to do on a physical basis, that you do that either during the course of the year or as we begin, like right now. I mean, we're in the 9th month of the year. We're beginning. We got 6-7 months of good data already. We're beginning that fall planning cycle, and the absolute thing that we need is credibility with the balance sheet accounts, including inventory. Because if you need to go out and count inventories, try to do it at month end if possible. Today is the 5th of September. If you did it today, then you'd obviously have to make an adjustment from the end of August. If you were going to back it back up to the end of August, you would have to obviously take in consideration the purchases you've made and the sales that have occurred since that point in time. But don't have an inventory done on the 5th or the 16th or the 18th of the month and provide that to your CPA and say, okay, here's my inventory. That's not going to help you worth it. I'm not going to say it. That's not going to help you at all. Because there's not then a number to adjust to at a month end. And if you don't have an inventory number to adjust to at a month end, when the normal accounting cycle occurs, then how do you know what kind of adjustment to make? So these are just common things and issues and problems that we see that obviously tie in hand with a cloud-based inventory system like the Datarithm has. So, Dave, you want to add anything to these comments?
No, spot on.
All right.
I just want to mention there's a lot of confusion about inventory and the role it plays into your bottom line and cost of goods and how all these things talk. So from an accounting standpoint, when you purchase a drug, you've got an accounts payable, you owe that money to the wholesaler. You've got inventory of say $100. Now, when you sell that drug, it goes through cost of goods. So at the end of the month, you check your inventory and say you only have 50 of inventory. You had 100, you now have 50. Well, that means you sold $50 of that inventory. So you can see how the inventory and the cost of goods talk. So if your inventory is wrong, your cost of goods is wrong, your bottom line is wrong. That's how those pieces talk to each other. And I get that question a lot. So I just wanted to be clear on that. All right. Perpetual inventory. So, we've been talking about this most of this whole conversation today, but Dave, if you had to leave our guests with one thought with perpetual inventory, what would that be for those that are considering hopping on board here?
Well, I believe that if you don't go to perpetual, you're exposing yourselves to all types of bad things. You're not going to be as profitable. You're going to be at higher risk for all various types of bad things. You're going to be spending more time at the end of the day doing your order. All these things are wrong. There's no question, or should be no question, why the big pharmacy chains, why do they use perpetual? There is a benefit there. They can be more profitable. They can be more efficient. I think that those things are clear.
I agree. Anything you want to comment here on this slide, Dave?
Package size and economies of scale. We harp on this quite often. You should always attempt to use pack sizes that are in keeping with the usage level of the drug. Okay, that means that if you're selling 100 units a month, don't buy the 1,000 pack. I mean, you're chasing pennies, and every time you order the 1,000 pack, you just basically ordered a 10-month supply. That exposes you to risks. That's going to keep more money on the shelf than you really need to. Go to your catalog, see if your formulary has a better size. That is very important. Using the wrong pack size, we see too often, is one of the cornerstones of why people have surplus. They're using the wrong pack sizes.
Yeah, that's a good point. That really is.
And you did mention returns and making sure there's no excess sitting out there for 30, 60, 90 days. And when you do return it, you'll get zero or something. We see that a lot. And how easy is that to catch and not have in an inventory system?
Well, in our system, we have a certain way of calculating what we believe is surplus inventory. And once we see that, that's where we throw the kitchen sink at it and go after potential returns to the wholesaler. If you have more than one store, transfers, we're always optimizing the order points based on usage levels. So, surplus and dead stock is caustic. It's costing you money right now, and it can cost you even more money tomorrow. So,
yeah, that's true.
Speaking about returns, unfortunately, we see too often that someone will go through, and it's the first time they've done it in a year or every maybe 6 months, they come up with $40,000 or $50,000 returns, and they send the return in to their wholesaler on the 20th of the month. Well, 6 weeks later, they get credited appropriately for whatever it is that they're returning. Well, if that's not handled right with their inventory, either and Dave, you might want to speak how that is handled with Datarithm. I know a lot of times we'll have an actual inventory taken during that period of time, and someone doesn't either mention that a return is in process or it hadn't been credited on the statements. But obviously, a $40,000-$50,000 adjustment to cost of goods sold and gross margin is a huge number, and a lot of times it doesn't get handled correctly. Any thoughts there or recommendations that you have from Datarhythm's perspective?
I would highly suggest that you don't do your returns once a year. Do it when you see the problem, right? Do it because if you delay and just say, I'm going to do it once every 6 months, imagine the carry cost that you could have eliminated had you done it more frequency, right?
Yeah.
And obviously too, if you're going to do a return, make sure you reduce your on-hand positions, because if you don't, now you've screwed up Olin's accounting.
There you go. There you go. That's exactly what we're saying. It's then you've just exacerbated the whole accounting issue there. We got another question from Alan here. How many days do you recommend for surplus items? I'm not exactly 100% sure of that question's meaning. Dave, how many days do you recommend for surplus items?
The word was surplus, correct?
For returns, I'm sorry. How many days do you recommend for returns? How many days do you recommend for returns?
How many days? I'm not, again, I'm kind of like in your position. I'm not sure the exact angle of the question, but
Alan, is that like how many times a year should you be doing this? We're just trying to get a firm understanding of what your question is. What percentage? No, that's another question. Let me go on to the next question. Maybe Alan will make this question a little bit clearer for us. I'm sorry, Alan. What percentage of sync fills or patients is your goal? What percentage of sync fills or patients is your goal? Let me take a stab at that one, then you can take a stab. If you don't have 60, 70% of your patients synced, med synced, I ask, why not? We have pharmacies that are doing that are literally having excess labor they're letting go home during the course of the month because they don't have anything to do, if you can believe that. That's true. So when labor is your second most important cost behind how well you buy, which is the most important thing,
And manage.
and labor is your second largest expense. And by the way, you want that labor to be under about 10.5%, including shareholders and owners, as the percentage of total accrued revenues. If you can reduce labor, whether it's through reduced hours, an hour or two in the morning, or Saturday afternoons you're closed, or even closed on Saturdays completely, depending on what fields that you have, and you can very easily determine what your income being produced per hour is. Um, that's this just really critical for you to keep all of this in consideration.
Yep. Any other questions?
Yeah. What are your turn goals? Like we talked about. I think my thought is a turn goal of 18 to 22 turns a year would be in a range of what I would think in a normal situation, Dave, properly using all the tools. You can easily see what would you say, because you're in the business.
I think that's a fantastic goal, given that the average is so low at 11, and the fact that there's evidence that people can get to those higher numbers. I mean, have a goal. I mean, if you don't have a goal, what are you striving for?
Yeah, exactly.
Dave, what do you see as normal returns? Should pharmacies have a lot of returns, or is that common? What is normal as far as returns? Like once every, very rarely, or what is ideal for returns?
What we've observed is that, and this is probably obvious, but with new clients, there will be a bolus of activity, because this is where we're going after hard in the beginning. So there will be more returns in the beginning than over time. But in terms of what should they be, if you're maintaining a more optimized position on your inventories, once you get through that bolus, you should see a drastic drop in how much return volume you have. Same thing with transfer, okay? Because we're recommending returns and transfers on surplus inventory. The only two reasons that we know that you can actually find yourself in surplus for an item is dispensing can drop, or the store, for whatever reason, is manually over ordering. Okay, so the PO says buy 1 pack and someone says no, buy 3. To that we say stop that, because in pharmacy, 5 out of 7 days of every week, if you order today, you're going to get it tomorrow. There's no real good reason, well, unless you're getting a real rock bottom pricing, to buy excess. So surplus is a problem, and so to answer the question, it's a matter of a bolus in the beginning. It should come down over time. If it doesn't, then either your people aren't doing the balancing work, the returns and the possible transfers, or you're one of the two other things where you're over ordering. Okay.
And as far as the system, when you say you log into the system and you see there's $220,000 of inventory, how is that cost information getting into your system? How important is it that that costing is correct? And what if they're buying from secondary wholesalers where the costing may be different from the downloads from their main wholesaler?
Right. Well, firstly, the cost is very important. It goes to important numbers in our system and important numbers for the accounting side of things. We get our cost basis from the interface. Okay, so they give us their cost for every single item. Is that net of rebate? No, it's whack in most cases. To touch on your point, well, they might be buying from a secondary, which doesn't have the same cost as their lead. Correct. And this is an unfortunate observation, but when you buy from your secondary and you're buying cheaper than your lead, if you're updating your on hands based on your lead wholesaler, your costing can be off in the system. There are some pharmacy systems that allow you to maintain, more accuracy by using what you did buy it for.
Yep.
The problem is, in many cases, it gets wiped out when the next cost file comes from the lead.
And I believe there is at least one, if not two systems out there that I'm aware of that allows you to lock in that lower priced item and not be overwritten with those daily downloads. Because what Dave is talking about can adversely affect the value of your inventory. If you're buying
Yeah.
$100 from source A and from source B, you're paying $70 a bottle, $30 difference times what you've got. That can be a huge difference over a period of time. And you've got to be very careful of that. And that's a problem we run into constantly.
That is a common problem we run
There are a
into.
number of script management systems out there that will not let you do that. There are some that allow you to do that. We've got some additional questions here. We're beginning to run short on time. I want to make sure we get all the questions. I want to get back to Alan's question. I think he came back and said, how many days would you allow an item to sit before deciding to return the item? How many days would you allow an item to sit before deciding to return the item? How would you answer that, Dave?
I would say that it's up to the owner of the management. In our system, that time frame is controlled by a setting. Typically, what we'll get to in the beginning, we'll open it wide open. We'll say days in surplus before return 0, so that we bring up as many possible returns and transfers, to that matter, in the beginning. When we see that they've started to do the work, we'll back that up to maybe around 10 days or so. That would be our typical position on that type of setting.
Okay. And from Lisa, Lisa has a question: what is the best way to determine your inventory turns when your cost of goods does not include your rebates, therefore not a true bottom line cost? Let me take a stab at that, Lisa. Inventory turns is cost of goods sold over a specified period of time, normally over a period of a year. You take your beginning and you end of the year inventory, you get an average inventory. You divide that into that cost of goods sold for that reporting period that you're trying to track. In this case here, a year. So I think your question is in part because, as Dave said, and we recommend what Dave just said, that you use WAC pricing essentially in that system, not net of rebates. Correct, Dave? Isn't that what you said?
That's what we use. That's what we get.
Yeah, and that's what we typically recommend. Rebates. This is a question we see frequently, but rebates are an uncertainty, both in terms of timing of that, whether you're going to get it, when it's going to be paid, how it's going to be paid. It becomes an uncertain situation. So it's very hard to be able to determine that and account for that in the system if you don't use WAC pricing. So I hope that helps answer the question, Lisa. If not, then on our next call, we can get more into that as we discuss. Anybody want to add anything to Lisa's comments or
Nope.
question?
I agree. It's perfect.
All right, one other question here. We've got just a few minutes left. Do all individual items have to have lot expiration info manually added to Datarithm for dead item and return management?
Currently, no.
Okay. All right. Dave, we've got a slide up here about Datarithm. Why don't you tell us about who Datarithm is and who you interface with and anything you'd like to hear?
Sure. We are an independent, small software company. We've been in business since 2005. You can see in the upper right of the screen the various leading pharmacy management system partners that we have. Pioneer, RX30, ComputerX. Kroll is in Canada, by the way. Liberty, RX Master, HBS, Script Pro, and coming soon, Best RX. In summary, I guess I would leave you with the thought that your inventory is your largest investment and your biggest expense. The better you can come to manage that, the better you will be operationally and financially. It is truly important.
And I don't see any further questions here. Just a closing comment or two. Feel free to access our website at sykes-cpa.com. We have literally hundreds of pharmacy industry specific topics, videos. We actually push one out about every 10 days or so. You can subscribe to our YouTube channel, Facebook, LinkedIn, Twitter. You can also see future webcasts that we have. Uh, the, um, the current series that we're doing now, we're attempting to integrate a lot of vendors that we deal with into the process of further and better understanding the products that are in the industry without having any conflicts of interest, which our firm has none whatsoever. And it's been our pleasure today to have you on this call. Since you registered for this call or on this call, and even those that are listening to this after the live call ends, you will be getting a copy of this call automatically sent to you by email. And again, we appreciate the opportunity to be with you today.
And we appreciate Dave for being on, and thank you for everybody listening, and stay tuned for our next webinar coming up in a couple weeks.
And Dave, we appreciate your help very much.
Thank you.
Thank you very much.
Yes,
Thank
sir.
you.
Take care.
Bye-bye.
Bye-bye.